Hi everyone and good morning. Thanks for joining us today on our webinar regarding tax in 2022 and what you need to know. Just some general housekeeping before we get started. The webinar is being recorded live, and any questions that you have, if you just direct them to the Q&A box at the bottom and we'll pick them up at the end. Okay, so introducing ourselves, I'm Jacqueline. I am one of the accountants here at Benson Wood, and I'm going to be joined by Bethany and Laura. And we're going to be covering all different aspects of tax planning and tax tips that we want to share with you. So our first section is tax planning. So coming up in the year ahead, there's quite a few significant changes that are about to happen. So you might have heard a few of these on the news. First of all, there's going to be an increase in corporation tax for some companies. There's also going to be higher dividend tax rates. There's going to be new capital allowances, such as the super deductions, which are already in place, but there's going to be more of a focus to use them up before they go. And there's also going to be a freeze on personal tax allowances and reliefs. And there's going to be a further expansion of making tax digital. So these are just some of the things that we're going to cover in the webinar today. So a quick guide is that the clock is ticking. It's really important to utilise everything that you've got available to you. So we have roughly about 5-6 weeks before the end of the tax year, and now is the time to be coming and speaking to us so that we're able to utilise any reliefs that may be available to you before the 5th of April. That way we can minimise your tax liabilities, but there's lots of steps that we can take, but planning is absolutely essential. So speak to us sooner rather than later. So business tax planning. So if you're a business owner, so some of the things that you need to consider is your current position before the year end. So the main one, if you're a limited company over, is the chances are you pay yourself in what we call dividend. Now, having utilised the everyone who pays themselves, who receives a dividend, is entitled to £2,000 tax-free. This is an absolute must. If you pay yourself in dividends, we will declare this regardless. It's tax-free, no implications, and even if you don't draw out the cash, you can have that saving up for a rainy day. Also, in regards to dividends over the next year, there is going to be an increase in dividend rates. So the dividend rates are going to go up by 1.25% from the 6th of April in each banding. Another significant change for business owners is corporation tax. So from April 2023, the rate of corporation tax is going to increase to 25% for some companies with profits over £250,000. And there will be a new marginal relief system in place. So that's really quite a big shock to business owners. So ideally what we'll be looking for is you to come and speak to us before, so we can get that tax planning in place for you. Carrying on the business tax planning, we have capital allowances. So the annual investment allowances is going to remain at £1 million until March 2023, which is great news. So incorporated companies should make use of the new super deduction scheme. So what that scheme allows is, it was brought in as part of the COVID relief strategy. So what that allows is for any new plant and machinery that the business actually purchases within this period, they are able to claim 130% of the value against their profits. Now, this sounds absolutely great, but before you go out splurging on all this new plant and machinery, again, come and speak to us and we'll help you plan ahead for it. There might be some sort of balance and charges in place for plant and machinery when we're disposing of it, so it's always best to speak to us before making any big decisions, and we'll help and guide you through. Another thing that a lot of people don't really know about is the research and development tax credits. So businesses claimed more than 7.4 billion of relief last year, and this is the biggest amount that anyone has ever claimed. So do you have any eligible projects? R&D can be anything to do with any sort of research and development projects. You can claim for staffing costs, any sort of direct cost in regard to that research and development. We do a quick calculation and we're able to get you some tax relief from your corporation tax. Another one is capital gains tax. So everyone has an annual exemption right now of 12,300, and this has actually been frozen to 2026. Now, most people would say a tax rate frozen, that's great news. Unfortunately, not so much. This one would usually increase and give you a higher allowance each year. So it's very essential that you're able to use all of your capital gains tax allowance each year to make most of the best use of it. We also have another relief. A lot of people might have known it as entrepreneurs relief. It's now called business asset disposal relief. And basically, you used to have a lifetime limit of qualifying gains of £10 million. That's been reduced to £1 million. So it is a significant change. So again, if you're thinking of disposing of your business, if you're a sole trader, get in contact with us and we will talk you through where we can best fit these reliefs. So another few tax planning tips is there's lots of different ways that we can reduce your annual corporation tax bill. We really need to look at the whole picture, and that's where we come in with your planning and things. So we'll support your goals and we can look at all sorts of things. So one of the main things is salaries. We can consider salaries of the directors. So most directors we would, you'll know, are on a small salary and paid in dividends. And this is just the most tax efficient way from removing company money from the business and enable to lower your corporation tax. There's also a wide range of other benefits and salary schemes available. So things such as electric cars and charging points. Just now, electric cars are getting, there's a 1% charge on a P11D benefit. This is going up to 2%, but it's still extremely minimal. And it also means that if you're providing your employees with an electric car, they're paying a very, very low amount to be able to use that car, and the company is getting the full benefit from taking off their profits. Some other planning tips are we've got the EMI share scheme. That's an efficient way to maybe reward your staff, give them some shares and give them a sense of really being part of the business and recognising that they are good staff and you want to retain them. Expenses, obviously working from home, a lot of staff have kind of maybe increased their expenses. Are you actually claiming for every expense that's available? Again, the best way to kind of work this out is come and speak to us and we'll figure out, and we can then let you know if there's anywhere that we can maybe increase this to bring it off of your taxable profits. Another thing as well is profit extraction. So are you making the most of the opportunities? If your business is really making great money, are you making the most of being able to get that money out of your business on a year-on-year basis? Or are you just taking the minimum? Again, it's all to do with tax planning. We would sit down at the end of the year meeting, we'd have a wee look at it and we would discuss the pros and the cons of obviously withdrawing more money and where it would kind of fit into your lifestyle and how much tax you want to pay. So that was more the business side of things. We've also got personal tax planning. So there is some points that we can help you to reduce your tax bill. So one of the main things is inter-spouse transfers. So when you have any sort of capital gains, so maybe selling a second property or anything like that, what you can do is you can use exempt transfers between spouses. So that basically means that between husband and wife, there is no capital gain tax to pay within those transfers, which is an ideal way of reducing your tax liabilities. What you can also do is you can exchange your salary for benefits. So you could consider exchanging part of, if you're a higher tax rate payer over the £100,000 threshold, what you could do is you could actually choose to make more payments into your company pension scheme, and that would take you below the £100,000 and thus retaining your personal allowance, which is great. Another option that we have is we have dividends and bonuses. So what we can do as well is if your year-end say is in August and your company really did great, but maybe it didn't do so great the year before, what we can do is if you come and speak to us early enough, we can declare an interim dividend and carry that back the way. And that then allows you to get more money out of the company within, say, the lower bands at a more tax efficient rate. So it may be worth having a conversation with us if you think that this applies to you. We also have directors' loans. So there's a tax-free amount that's interest-free on any loans. So it depends on your income level. But again, if you give us a little, if you come in, speak to us, we can absolutely speak to you regarding that. Another personal tax planning, personal tax situation arising is stamp duty land tax. So if you're looking to purchase a home or a second home in 2022, you have to consider the stamp duty land tax. This is an additional tax that's placed on the purchase of a property. All the paperwork will need to be filed. So you may so there could be a 3% surcharge on top of the current rates of stamp duty land tax. So what you want to do is speak to us in advance, and we will go through all of the charges and taxes that are applicable to any of those sort of decisions that you're thinking of making. So another thing that we can do in order with tax planning is inheritance tax planning. So as well as focusing on your year end and your current situation, what you may need to do is make sure that you have plans in place for your future, especially if you're among the growing amount of people that are affected by inheritance tax. It's always a good idea to think forward for your loved ones, and what would happen if you weren't here any longer. Where would your business dealings go? So some of the things that you can do to reduce your inheritance tax is you could issue a charitable gift. So if you leave at least 10% of your net estate to a charity, you will then pay inheritance tax on anything above the £325,000 personal limit. You would pay a reduced rate of 36% rather than 40%, and that essentially could save your family lots and lots of money. You also have an annual gift allowance, so you are able to give away a total of £3,000 worth of gifts per year per person each tax year without these having to be added to the value of the estate. This can be carried over 2 years if it's unused, and larger gifts above this allowance will be subject to the 7-year rule. So the 7-year rule is that anything that you gift to someone who isn't your spouse would then be subject to the estate, the inheritance tax purposes. But what they do to relieve that is over 7 years, they'll use something called taper relief. And what will happen is the tax liability over the 7 years will reduce and reduce and reduce down, so that at the end of the 7 years, there is no tax payable. If you gift something and then you live for 7 years, there will be no inheritance tax payable on that. Gifts out of income. So you can make regular gifts out of your income, which are tax-free if they're used for things like normal expenditure. So this is surplus income. Any surplus income that you have, you could use potentially to pay children's or grandchildren's school fees. This would be out with the scope of your inheritance tax estate. And also you're helping out your younger ones for their future. Another gift that you can do is your parents are allowed to gift their children £5,000 for the cost of a wedding, and grandparents are allowed to gift £2,500, and any friends or other relatives are allowed to gift £1,000 without this then being considered part of your estate for inheritance tax purposes. What we also do is we encourage you to revisit your pension plans and update your will to ensure that your family receives the full benefit of any remaining pension funds. Every year the allowances are changing, so keep in touch and we will keep you on the right path to making sure that you really maximise what you can give tax-free. There's many ways that formal trusts can protect and maximise your family's future assets. There have been a number of changes to the treatment of tax funds recently, which are complex and they could affect some people. So that's my section on the tax planning tips all done, and I'm going to pass you over to Laura now, who is going to quickly talk you through pensions and tax.
Thanks, Jacqueline. So as Jacqueline said, I'm going to talk through pensions and tax. So obviously no one wants to see their pensions targeted by the taxman. So here's a few things that you can consider. So there's protecting your pension. So the lifetime allowance, LTA, has changed considerably in recent years and currently stands at £1,073,100 for the 2021 year. So this is the full amount that you can put in, and it's subject to change each year. You also have your annual pension allowance. So have you used your full pension allowance? You can invest up to £40,000 a year into a pension tax-free. This amount can be carried over 3 years, allowing you to use unused allowance to top up your pension. So say you put in £20,000 last year, you could put up to £60,000 in this year. If you just pop to the next slide. So you have stakeholder pension. All UK residents, including children, can make annual net contributions of £2,880. So that's 3,600 grossed up, regardless of whether they have earnings or not. So you can save for your child's pension if that's something that you've considered. You also have pension drawdown. So if you're 55 or over, you may be able to start drawing down your pension benefits now from a personal pension such as your SIP, that's your self-invested personal pension, even if you're still working. So 25% of what you take out will be tax-free, and then the rest will be taxed at your marginal rate. Next slide. There are a lot of ways to help reduce your tax liabilities. Some of the tax efficient ways to consider using are your ISAs. So this includes your Help to Buy ISAs, your lifetime ISAs, stocks and share ISAs, and your child ISAs. So obviously you get you can put up to £20,000 per year into the ISAs. You also have share schemes where your employer offers you company shares and you can get tax advantages. So that's like not paying your income tax and national insurance on their value. You have EIS, which is Enterprise Investment Schemes, and SEIS, which is Seed Enterprise Investment Schemes. So these offer tax relief to individual investors who buy new shares in your company. You have your venture capital trust investments, so that's your also known as VCT. So this is a company like an investment trust that is approved by HMRC and invests in or lends money to unlisted companies. You can claim up to 30% investment and can also receive tax relief on income from dividends. You also have other investments like community and social enterprise investments, where you can invest your money and receive tax relief. And finally, you have your bonds, like your life insurance and offshore bonds, where you can lock your money in and receive tax relief from that as well. So if we just pop over to the next slide, I'm now going to pass you on to Beth, who's going to go through making tax digital for VAT.
Thanks, Laura. So I'm going to be talking about making tax digital for VAT. So this is also known as MTD, and it's HMRC's way to digitise the system and make everything online. So it requires businesses to use HMRC compliant software to record and report all VAT information, and the reporting on this must be done once every quarter. Next slide, please. So currently, VAT registered businesses above the taxable turnover of 85,000 have had to comply since 2019. So many businesses underestimated the preparation that was needed for going MTD, so it is best to start preparing early. So businesses were given an initial soft landing period for 6 months to put things into place. However, new businesses no longer get this. So these are the upcoming changes from April 22. So all VAT registered businesses will have to comply with MTD no matter the threshold. Businesses will have to follow the same regime that companies part of MTD already do. And as previously mentioned, this is being part of HMRC compliant software and reporting the VAT information quarterly. So in order to prepare for this, businesses need to implement systems that can record and report information in each quarter within HMRC rules. So to be compliant, the software must be able to keep and preserve digital records. Also to create VAT and tax return information from these digital records and report to HMRC electronically. You can also provide data voluntarily to show that you are complying. And again, all of this must be done each VAT quarter. So this is the MTD roadmap, and as you can see, there is still lots of changes ahead. So at the start in 2019, this is where MTD for VAT became mandatory for businesses above the threshold. And then you can see the soft landing period of 6 months, which is now ended. Then you can see where we are at now. So the next change is April 2022, where MTD for VAT will be mandatory for all VAT registered businesses, no matter the threshold. Then in the future, in 2024, MTD for income tax will become mandatory for most self-employed businesses if you have a taxable turnover above £10,000. And then in 2026, this is the earliest date at which businesses will need to report corporation tax via MTD. Thanks for listening. If you've got any questions, you could just leave them in the Q&A box at the bottom.
Thanks very much, Beth. So we have a question. Thanks very much, Beth. So we have a question here. I have 3 daughters and 2 stepdaughters. To reduce inheritance tax, can I give £5,000 to each daughter for each of their weddings? Yeah, the answer to that, John, is yes, you can. So as I mentioned before in the inheritance tax section, so if you are a parent, you are able to give £5,000 to each daughter for their weddings. If you are a grandparent, that reduces to £2,500. And if you are a friend or another relative, it's £1,000. And these are all out with the scope of the estate. So absolutely tax-free and don't come into inheritance tax. Is there any more questions? That's great. Well, thanks for joining us. I hope you've taken away something really interesting or something that you maybe didn't already know. But our contact details, you could contact us anytime and we'll be happy to sit through and do some planning with you. Okay, thank you.
Thanks.